Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Fatia binti Sabaruddin. My metric number is 068794. We will present about the first chapter of Management Accounting, which is an introduction to Management Accounting. Now, let's go to the first point, users of accounting. We have two users of accounting, internal users and external users. First, internal users is a person or an organization who help run its operation and use company's financial information to make a decision and make an adjustment for future activities. Internal users include managers and employees. Second, external users. External users is a user of the system who is not part of the organization structure. External users such as supplier, creditors, customer, and investor use the financial information to help them understand the company's financial position and past performance. The external users use this report to develop business plans as well as make business decisions about the company.
Thank you. My name is Nurul Izzah binti Ihsan. My metric number is 065815.
Next, I will explain about objective of management accounting. Management accounting helps managers strategize, course correct, and make informed decisions based on the analysis and interpretation of the financial data related to the internal operation of the company. Management accounting is a virtual tool to help the managers of an organization steer it. Secondly, it uses accounting data to solve various management problems. Management accounting techniques like cost volume profit analysis, standard costing, budgetary control, capital budgeting, funds flows analysis, and else assist the management in arriving at the correct decisions. Next, management accounting can aid the SWOT analysis by setting up processes for collecting and creating competitive intelligence to help keep it objective and current. They can use their skills in performance measurement to benchmark the company against competitor for identifying areas of strength and weakness. Last but not least, management accounting establishes performance measure of individuals and organizations. Performance measurement cannot be addressed by financial accounting only, and hence, tools devised by management accounting need to be deployed to achieve segments and managers' performance measure in a given period.
Thank you. Now it's my turn. My name is Nurfara Ayumi binti Rosli. My metric number 066094. I will presenting about Accounting Information System. AIS is a subsystem of Management Information System. Collects and processes transaction data, communicate financial information to decision makers. Includes each of the steps in the accounting cycle. There are three elements of AIS. First, input. The inputs are source documents that evidence the financial transaction of the business. Source documents are typically invoice, receipt, deposit, slip, checkbooks, authorized memos. Second, process. The process used in the accounting information system is double entry bookkeeping. This ensures that transactions are recorded in journals in chronological order and posted to ledger that sort the transaction into account type order. Third, output. The accounting process then delivers output in the form of financial statement that give a view of the financial position and performance of the business. The two key financial statements are the income statement and the balance sheet. Next, we move to two basic concepts of AIS. First, manual system. Traditional method use of pre-printed form, handwritten details and report and storing data in file cabinets, box and warehouse. Second, computer-based. Use computer technology, which is computer hardware, software and telecommunication channels. Components of AIS. First, people. The people who operate the system and perform various functions such as accountants, managers. Second, data. Data can be anything like sale, ledger, financial report, balance sheet, and cash flow statement. Third, establish procedures is a rules for achieving optimal and secure operations in data processing. Fourth, software. Software ERP. A software ERP is a computer-based program that performs the stated functions that support business processes and operation. Information system infrastructure. IT infrastructure can be a consortium of various IT and IS hardware, tools, and accessories. For example, computers, printers, scanners, and others. 6. The internal control. These are tools, check, procedure, system adopted by an organization to ensure the integrity of financial information, prevention of frauds, errors, safeguarding of assets.
Now it's my turn. My name is Romashita binti Zainal. My matrix number is 066285. I will present about the main difference in financial accounting. Before that, I will explain about the definition of financial accounting. The process of recording, summarizing, and reporting the numerous transactions occurring from corporate operations throughout time is known as financial accounting. The first difference in financial accounting is historical in nature. Financial accounting only takes into account transactions that are historical or those that have already occurred. In financial accounting, futuristic transactions are not allowed, regardless matter how significant they may be from a commercial perspective. Secondly, a general ledger is a company's financial data record-keeping systems, with debit and credit account records validated by a trial balance. It keeps track of every financial transaction that occurs during the life of an operating company and stores account information required to prepare the company's financial statements. Transaction data is separated into accounts for assets, liabilities, on equities, revenues, and expenses based on types. Thirdly, financial accounting aims to prepare a company's financial statement for a specific time period. The balance sheets, income statements, and statement of cash flows are the three most common types of financial statements. Next, there are many target uses for financial accounting. Among them are, firstly, business management. The management team must be aware of the organization profitability, liquidity, and cash flows each month in order to make operational and financial choice for the company. Secondly, competitors. A business competitors will make an effort to obtain access to its financial statements in order to assess the state of its finance. Their competitive strategy might change as a result of the new information. Lastly, customers. When choosing a supplier for a significant contract, a customer will want to first study their financial statements in order to assess the supplier's financial viability in order to deliver the goods or services specified in the contracts. The fifth is regulatory requirements. Generally accepted accounting principles are the general set of accounting principles, standards, and accounting procedures that businesses and their accountants must follow when preparing financial statements. In contrast, International Financial Account Reporting Standards (IFRS) are a set of international accounting standards that specify how certain types of transactions and other events should be reported in financial statements. The International Accounting Standards Board (IASB) issued IFRS, which specify how accountants must keep and report their accounts. Furthermore, the types of information where the financial information is supported by notes to accounts for external users such as suppliers, banks, customers, investors, potential investors, and tax authorities. Moreover, the nature of information is that the financial statements used in accounting are a concise summary of financial transactions over an accounting period, summarizing a company's operation, financial position, and cash flows. Knowing the liquid asset is one of the benefits of financial statement since it can be used to manage debts owed and pay the highest cost liability first. In addition, financial statements must be prepared at the end of the company fiscal year, but some companies update them monthly. The income statement, statement of retained earnings, balance sheets, and the statement of cash flow comprise a financial statement. Keeping financial statements up to date on a regular basis allows business to grow, plan for the future, and better identify their capital requirement. Lastly, auditors account sign and fill annually. Law requires public companies to have their financial statement audited by a registered certified public accountant. The independent audit purpose is to ensure that company management has presented financial statements that are free of material errors. Hiring an independent and qualified CPA also assures banks, suppliers, and potential investors that the company is financially sound and creditworthy. Financial statements that have been audited are required to provide information to decision makers. That's all from me. Now I'll pass to Hasliza.
My name is Nur Hasliza binti Sukri. My metric number is 067887. Now, let's move on to managerial accounting. As you are all aware, accounting has made a few types of specialties that can benefit firms in a number of different ways. One of the most important aspects of the company's accounting is managerial accounting, which one that we will be looking at. Managerial accounting provides information to a manager for use within the organization so that they can formulate plans, control operations, and make decisions. Planning is the process of establishing goals and specifying how to achieve them. It is a big part of the manager's job, and as a result, managerial accounting has a strong orientation towards the future. Besides, managerial accounting almost always report at more detailed level, such as profit by product line, customers, and geographic region. This is important to keep everything organized on track, especially for a small firm. Managerial accounting are more likely to only be used by insiders and to be used in improving operations. Managerial accounting frequently deals with estimates rather than proven and verifiable facts. It helps the management the part of accounting that helps manager in making decisions. Providing accounting information is called management accounting. Management accounting is a special branch of accounting. It is a modern and scientific innovation of accounting. Other than that, managerial accounting helps to emphasize decisions affecting the future, relevance, timeliness, and segment performance. However, managerial accounting is not mandatory for a company to do so. As a company, they can choose to do a managerial accounting or choose to not do without any penalty from SEC. However, a company that does not use it will suffer great consequences. What we can conclude is, accounting is important in organizations that provide forecasting and planning tools to make managers who make the decision.
Hi, my name is Umi Saada binti Abdurrahman with matrix number 066837.
Next, we go for a changing role of management accounting. Stage 1 is cost determination and financial control. Rapid developments in cost accounting theories and techniques lead to the development of cost accounting. Cost accounting data was initially created for the purpose of product costing and profit calculation. This role evolved over time to include elements of planning, control, and decision making. Management accounting function introduced planning and control tools such as standard costing and variance analysis. Standard costing was an essential component of production planning, while variance analysis was used to control costs. In general, the traditional management accounting tools and techniques developed in Stage 1 aim to achieve manufacturing and organizational goals. This period of management accounting evolution was referred to by IFAC as a period of technical activity required for the pursuit of managerial objectives. Next, Stage 2 is transition to management accounting. The transition from cost accounting to management accounting occurred principally in the 1950s. The establishment of a multi-divisional organizational structure during this period contributed to the accounting information era. Manager-centered responsibilities focus on the provision of information to enable more efficient planning and control decision. This allows management accounting to be applied to more complex areas such as divisional transfer pricing and long-term planning and control decision. The management accounting developments in Stage 2 continue to serve the traditional cost accounting functions with the development of the time value of money concept. Capital budgeting techniques such as net present value (NPV) and internal rate of return (IRR) were introduced for evaluating long-term decisions. The management accounting developments in Stage 2 continue to serve the traditional cost accounting functions with the development of the time value of money concept. Capital budgeting techniques such as net present value (NPV) and internal rate of return (IRR) were introduced for evaluating long-term decisions. Next, we go for Stage 3, which is Introduction to Strategic Management Accounting, also known as SMA. Stage 3 of the management accounting revolution was dominated by Japanese companies that adopted quality as their key competitive tool. A renewed emphasis on waste reduction contributed to the development and widespread acceptance of quality management in management accounting literature. Target costing and cost reduction exercises were introduced from the design and development stages to manufacturing as a result of development. Over time, the successful application of these techniques resulted in a new direction for management accounting best practice. The last stage is Stage 4, which is widespread use of SMA practice. Most of Stage 4 developments involve spotting strategic positioning and developing or adapting management strategies required for organizational success and survival. Emerging strategic management practices such as value-based management and quality management practices heavily influence developments during this stage. SMA techniques are affected by both external and internal factors. Life cycle costing, benchmarking, supply chain management, and strategic quality management initiatives are examples of external factors. Internal factors, on the other hand, influence the type of SMA techniques used, such as value chain management, theory of constraints, process management, activity-based management, and the development of an integrated or balanced performance measurement system.
Lastly, the importance of ethical behavior for managers and management accountants. First, competence. Maintain an appropriate level for professional expertise by continually developing knowledge and skills. Integrity. Abstain from engaging in or supporting any activity that might discredit the profession. Confidentiality. Refrain from using the confidential information for unethical or illegal advantage. Last one, credibility. Communicate information fairly and objectively.